Good morning, folks, and welcome to Stock Charts today. It is the 13th. At current, it is 5 a.m. in the morning, Eastern Standard Time. Let's get to it. Let's begin with the S&P 500. I want to bring you back to yesterday morning, and I want to draw a correlation between the new financial news media, guys like me, and the establishment media. And I want to draw a correlation between the two of us because I take a lot of swings at CNBC and at the Wall Street pundits, and I do so for a reason. Now, yesterday morning, we were rallying strong, and I warned before the market opened that we would see a pause and a pullback, in all probability, just prior to the market open or immediately after. We got both. And here's the fade yesterday, and by the end of the day, the S&P 500 had flashed a bearish key reversal. Here's what I had to say. What you're going to hear going into this week is that the jobs data set the tone for the next leg higher in the market. What's my response to that? Maybe. But what you're going to hear on CNBC are the talking heads trying to take up parking space in your head, trying to get you to believe that it's all safe to go back in the water. Before you do that, please, we need to take the economic data as a whole, not as an individual report, as a whole, and appreciate what it has been telling us. And net, the economic data that has been coming out over the past couple of weeks has been very, very weak, with the jobs report being the outlier. And remember that while the headline number, which is all they want you to look at, the headline number, the big beat on the jobs number, remember that what they don't want to talk about all that much is that the average hourly work week did not expand as expected, and that earnings were subpar. So again, don't let these thugs take up parking space in your head. That is all they're going to want to talk about, meaning the jobs number. When they go on CNBC, the slick-back salesmen who call themselves fiduciary money managers, all they're going to want to do is take up parking space in your head. Don't let them do it. Getting back to the S&P 500, we are having a strong morning. We're up 9.5 points on the morning. We're coming off the highs of the session somewhat, but still a strong morning. I'm not going to be a bit surprised to see a pullback here fairly soon, perhaps even before the market open. Now, fast forward to later in the morning where you had CNBC bring on this talking head from Payton and Regal, and here's what this slick-back salesman had to say about his educated opinion, and I say that tongue-in-cheek, his educated opinion of as to where the markets are going. Let's take a listen.
I think is the next catalyst for stocks?
Well, I think the next catalyst for stocks is going to be, first of all, I think we've always got to look at the long term, Dan. The next catalyst for stocks will be tomorrow's, or the inflation numbers, which will be out shortly. And inflation continues to remain under control despite the fact that we're seeing some very good growth here in the United States and around the world for that matter. So certainly in the short run, the next catalyst will be the inflation fix. But the longer term, the fundamentals remain very, very solid for stocks and for bonds as well.
All right, so you heard him. He said to buy stocks because the economy is strong. And by strong, I guess he means that the 2.5% GDP growth that the Atlanta Federal Reserve predicts for Q1 is strong economic growth. Now, that seems to be a low bar in my book, but okay, he's the expert, right? He's the salesman, so we should listen to him. We should pray at the altar of his intelligence, and God forbid we question it. But here's what he goes on to say later on, only seconds later. Here's what he goes on to say about stocks.
So are you saying that I should be adding to equity positions in this environment, or is this market still looking perhaps a little bit overpriced?
Well, when you start talking about valuation, Dan, it's all in the eyes of the beholder. I think that certainly stocks are arguably fairly valued today, if not somewhat highly valued. But I think it's important to really look in the future and get.
All right, so you heard him. Now I'm confused. Is the economy growing? Should we buy stocks, or are they overbought? That's all I want. If you can't tell me in one simple, concise, succinct sentence of as to why I should or should not buy the market long-term or short-term, I don't need your opinion. Yet this is who CNBC is bringing on to offer us free advice. I don't have an account with Payton and Regal, yet they're coming on and offering free advice. Here's what this genius leaves us off with. And note how at the time he was speaking, the markets had flashed a bearish key reversal on the day.
I think could cause or could enable stock prices to move up further. So yes, they are slightly highly valued, but given the positive outlook going forward, there certainly is room for them to continue.
So folks, this is what I mean. This is what I talk about all the time. These guys like to take up parking space in your head. Both CNBC and the Wall Street banksters, they do this all the time. Don't let them do it. And this is the difference between the old establishment financial news media and guys like me who just want straight talk. Let's get to the charts of the morning. The S&P 500, they are rallying off of the lows of yesterday. We have not taken out yesterday's highs. We have the inflation data coming out this morning. We also have retail sales this week as well as the PPI. That's the Producer Price Index. A lot of inflation data coming out this week. The dollar. We spoke about the dollar yesterday. We have a possible head and shoulders setup here. Left shoulder, head, right shoulder. Or we could say that we have a bull flag formation going on here. Now today we have the inflation data that's coming out. If it comes out hot, you should expect to see a rally in the dollar. And you may be saying, wait a minute, Bob. If the inflation comes out hot, the U.S. dollar should drop because that's inflationary and that's not good for the dollar. What you're using is logic. You're not using Wall Street logic because the way traders will see it is that the Federal Reserve will need to raise rates more aggressively in order to combat inflation. Now, the Japanese yen, which I spoke about yesterday morning, is really getting hit hard today. And if we take out Friday's lows, we are going a lot lower on the Japanese yen. This is a fairly bearish setup here and another head and shoulders setup going on. We have lower highs and lower lows getting put in on the Japanese yen. So this would be bullish dollar, bearish for the yen, obviously. Let's take a look at the euro. The euro can't get out of its own way. Lower highs. We are beginning to put in higher lows, though. So a consolidation is forming. Taking a look at gold. When I went to bed last night, gold was selling off the highs of the session. It was up, though, but now it is down $2.90 on the session. We broke out yesterday above this upper band of resistance. We're probably going to pull all the way back down to retest the breakout point. If inflation comes in lighter than expected, expect a rally in gold because that will give the Federal Reserve the cover it needs to not have to raise interest rates. Let's get to member stock chart requests. First chart up, Lam Research. All right, on a weekly basis, we broke out last week above this upper band of resistance. And on this daily chart, you could see that we have a bit of a megaphone formation which had formed. We broke out of that megaphone formation last week. Yesterday, we saw a continuation breakout, a new weekly high. We're a bit extended here. Ideally, for a good entry point, you're going to want to see a pullback to the 217.93 level, which would be this support level here, and look to open up your position. I wouldn't go chasing it. In all probability, these shares are going higher. Longer term, volume, outstanding volume, institutional demand. I like this setup. I would watch for the pullback, though. And then I would buy more on a breakout. Micron Technologies, weekly chart. These DRAM chip makers are in fuego. In fact, the entire semiconductor sector is in fuego. I mentioned it yesterday morning. I was short several weeks ago of the semis on an opening position, and thank goodness I had the wisdom to stop out of the position. And as I said yesterday, that's when losses are good, when you can look in the rearview mirror and thank your lucky stars that you took that loss. Because had you fought the market, you'd be sitting with a big fat loss if you were short of the semis. Now, weekly chart, Micron broke out of resistance 2 weeks ago. We have a follow-through week this week. The problem is this, folks, is that we are leaning into the third standard deviation Bollinger Band. And I catch a lot of flack when I say that, because a lot of traders, a lot of new traders, not experienced traders, a lot of new traders, they don't know what that means. They look at their Bollinger Bands and they're not lining up with their charting software. Well, if you take a look at my 2 standard deviation Bollinger Band in green here, that'll line up with your software. That's the out-of-the-box Bollinger Band. It's usually a 2 standard deviation Bollinger Band versus the 3 that I have in red. Now, what does that mean? It just simply means that relative to this dotted green line here, which is the 20-day moving average, the 2 standard deviation means is that it's trading twice the deviation from the 20-period moving average, which in general, it's not normally supposed to be. It could stay there for a few days, but in all probability, once you get above that level, you're going to get a pullback and a reversion to a retest of the 20-period moving average. When you have a 3 standard deviation Bollinger Band up there, basically what it's telling you is that you are now trading at 3 times the standard deviation away from the 20-period moving average, which is obviously more rare than the 2 standard. That's why I have it up there. So when we're leaning into it, it's telling me, you know what, this is a fairly rare event. I mean, look at this chart here. This is a weekly chart going all the way back to late 2013. How many times have you seen the shares of Micron Technology trading into the 3rd standard deviation Bollinger Band? And I only see one series of occasions, and that was right here in late 2017. And while we didn't get a big pullback, and while I'm saying that we are leaning into the 3rd standard deviation Bollinger Band, it doesn't necessarily mean we're going to get a correction, right? It could trade sideways, alleviating that oversold condition, and then off to the races once again. So all I'm saying here is that it's a warning flag. Now, if we were extremely overbought on RSI and leaning into the 3rd standard deviation Bollinger Band, I would say you better put in a tight trailing stop loss order and let the markets take you out. We're not there yet. We're not at that level of overbought condition. Daily chart. Now, on a daily basis, the market is sending you signals, folks. Yesterday, we saw a big topping tail or wick on top of our candlestick. What does that imply? It means that you have profit takers above. So would I take my entire position off the table? No, it's a strong stock. Would I scale it back a bit? Yeah, in all probability. Given the fact that I know that the weekly chart is telling me that I am leaning into the 3rd standard deviation Bollinger Band and that there's a great chance that I am going to see a pause or a pullback, and the daily chart is telling me, wow, I have RSI at 80 in a market that is iffy, I would look to take some of my position off the table. My stochastics are rolling over. Does that mean I go selling my position? No, because it could hook back up again. You know, a lot of times you get these books, Technical Analysis for Dummies, and I'm picking this one out. They tell you to sell the stock once the RSI goes over 70. You'd lose a lot of profit. As a contrarian, I am of the mind that you look to buy a stock once it goes over 70 or 80 because it's a measure of momentum. It's a measure of demand. And you use your candlesticks, your historical resistance levels, your RSI, your volume bars, which on MU are outstanding. This may in fact be a tell of a blow off top here, so beware. I use those signals to tell me when I should scale back on my position, not necessarily the Stokes. Now, if we begin to put in lower highs and roll over on the Stokes and break down below 80 and make lower lows, that's a different story. Then the game is beginning to change, and I'll look to scale back that position even further. So MU, long story short, I would not short the shares. I would look to begin to scale back on my position. But as it stands right now, the path of least resistance remains higher, net. I would not go buying them right now. If you get a pullback, a bull flag formation, a triangle formation, any consolidation that's a continuation breakout consolidation, then you could look to add more on a breakout. PTLA, Portola Pharmaceuticals, a huge sell-off. We bounced off of historical support. We're consolidating here. We may get a rally off of this, but you have a lot of resistance above. This is certainly not a short, folks. Would I go buying it? It's a difficult case to make. Stokes are interesting in that they appear to want to move higher. Whenever you get a consolidation like this, a tight consolidation along the 2 and 3 standard deviation Bollinger Bands, in all probability, you're going to get a rally. The question is at what resistance level does it pause? And we have resistance immediately above at $40 and $42.74, and then at $46 per share. A lot of overhead supply to get through. Daily chart. Now, on a daily chart, we broke out and above the upper band of resistance on RSI. We're pulling back to do a retest. We gapped down a couple of weeks ago. This is a dead cat bounce. We pulled back yesterday and we rallied off the lows of the day. This is a difficult one to call. You know, if I had to buy this one, it would either be on an extreme pullback and a retest of prior lows, either down to 32 or to $30.10 with a stop loss right below, or on a close above 39.80. And if we rallied up and through, let's throw another line up here. If we rallied up and through $45 per share and closed there, well then, that is a really nice setup. But as it stands right now, this stock is in no man's land. Again, you have resistance above, right here at 39.80, not too far away. So you have a lot of risk, little reward if you put on a trade. So again, I would look to open up a position if I were buying strength on a close above 39.80, add more on a breakout above 45, or wait for a pullback and a retest of prior support. I see zero reason to go rushing in here to buy these shares. Esperon Therapeutics weekly chart, a really nice setup here. The path of least resistance is clearly to the upside. We reversed yesterday off of the lower band of support and closed near the highs of the day. No breakout yet on our indicators. Daily chart. Now on a daily basis, we had a beautiful bullish engulfing of the prior day's move. We broke out yesterday above the upper band of resistance out of this bull flag formation. Volume outstanding. We broke out an ultimate oscillator. Stokes are hooking up. RSI is hooking up. I think that these shares could be bought on a close above 82.68. I would wait until then on a closing basis before I opened up a position. Now, if we pull back here and retest the breakout point, I would buy between $76 and $77 per share with a stop on a close back down below $76 per share. That would drop you back down into this prior trading range, which would be a breakout point failure, and I would want no part of that. I would stop out of that position on a failure to hold this breakout point. And that's it for this morning, folks. Keep an eye on the inflation data. Members, I will be in the forum later. We'll do a market wrap. If you didn't watch last night's market wrap, it is posted in the members area. Go check it out. If you're not currently a member, our membership is closed right now. Actually, you can sign up for the bronze level membership. Click that link above and you'll be taken to the checkout page. If you're watching this on YouTube, please subscribe to my channel. Click that bell and you'll get notified of new videos. If you're watching this on the website, please enter your email address. We hate spam too, and you get notified of whenever I send out best stock charts. I normally don't send stock charts today out to non-members because I don't like spam. I worry about getting too spammy. So it's best just to subscribe to my YouTube channel and click that bell button. You'll get notified of new stock charts today. Everybody have a great trading day. Have a profitable one. Be well.